The AI bubble burst. Amazon just lost billions in value overnight. And they aren't alone. If you've looked at your portfolio recently, you've probably seen a sea of red. Why? Because big tech just admitted they're planning to spend hundreds of billions of dollars on AI. And investors are suddenly asking if the AI party is finally over. Today, we're breaking down the tech sell-off, what just happened, why these stocks are dropping, and whether this is a buy the dip opportunity or a warning sign you can't ignore. Let's start with the news. Amazon's latest earnings dropped a bombshell, not because they aren't making money, but because of how much they plan to spend. We saw an immediate slide in the stock price, wiping out massive shareholder value in hours. And it's not just Amazon. Alphabet, Meta, other big tech names all feeling the pressure. The narrative has shifted. For the last 2 years, Wall Street said, buy anything with AI on it. Now, they're asking a much harder question. Who is actually going to pay for all this infrastructure? Let's talk about the scary word of the week, Capex. Capex, or capital expenditure, is the money companies pour into physical assets, servers, chips, data centers, all the hardware needed to power AI. Right now, estimates suggest the big cloud players Amazon, Google, Meta, Microsoft are gearing up to spend close to $700 billion on AI infrastructure over the next few years. For 2026 alone, reports indicate Amazon could be staring at a $200 billion bill for AI chips, data centers, and related infrastructure. To put that in perspective, that's more than the annual GDP of many countries. Investors are looking at Amazon's legendary free cash flow and seeing it get eaten alive by data centers and NVIDIA GPUs. This is why the market is freaking out. This isn't a few billion here and there. This is betting the farm. If these AI models don't start generating serious, recurring revenue, and not just cool demos, then all of this spending starts to look less like an investment and more like a bonfire of cash. So the big question, is this the dot-com bubble all over again? Let's rewind to the late 1990s and early 2000s. Back then, telecom companies spent billions laying fiber optic cables across continents and under oceans. They built an internet backbone for traffic that didn't exist yet. The logic was, if we build it, the demand will come. But they built too much, too fast. A lot of those companies went bankrupt when the bubble burst. Their infrastructure was real, but the business models weren't. Now look at today. We're building enormous data centers and buying mountains of GPUs for AI agents and AI use cases that don't fully exist yet at scale. We're doing the same thing, building infrastructure ahead of demand. That's the uncomfortable parallel with the dot-com era. However, there is one big difference. In 2000, many of the companies that were worth billions had almost no revenue, no profits, and no real path to making money. Today, Amazon, Google, Meta, and Microsoft are already profitable, cash-generating machines. They're not going bankrupt tomorrow, but their stock prices? Those can absolutely reprice if investors decide the AI story won't pay off fast enough. So where does that leave you as an investor? Do you sell everything and sit in cash? Or is this exactly the moment long-term investors have been waiting for? Here's how I see it. If you're a short-term trader, you should expect volatility. The market hates uncertainty, and we're going to spend hundreds of billions of dollars on AI, and hope it works out is the definition of uncertainty. These stocks can swing hard in both directions on every earnings report, every AI headline, every comment about Capex. But if you have a longer time horizon, 3, 5, 10 years, the picture looks different. Think back to the dot-com crash. The companies that survived, like Amazon and Microsoft, eventually became some of the most valuable businesses in history. Yes, their stocks crashed. Yes, investors were terrified. But the infrastructure that was built during that bubble eventually became the foundation for the modern internet. We may be seeing something similar with AI. The data centers, chips, and infrastructure being built today will almost certainly be used. The real unknown is, how quickly will the revenue catch up to the spending? If you believe that AI will be deeply integrated into every industry from healthcare, to finance, to logistics, to entertainment, then this sell-off may look, years from now, like one of those rare buying opportunities that only appear a few times in a decade. If, on the other hand, you think AI is mostly hype that it will remain a niche tool rather than a core economic driver, then these Capex numbers should worry you. In that case, taking profits or reducing exposure to high-flying names might be the rational move. So here's the balanced takeaway. In the short term, expect pain, volatility, and scary headlines about spending. In the long term, the winners of this AI arms race are likely to be incredibly powerful, but not every company spending billions today will come out on top. For most long-term investors, that means being selective, not panicking, and using fear-driven sell-offs to slowly build positions in the strongest, most durable businesses, instead of chasing whatever stock is hot this week. Now I want to hear from you. Are you buying this dip in big tech and AI names? Or are you sitting this one out, maybe even selling into the rally when things bounce? Let me know in the comments. If you found this breakdown helpful, consider subscribing for more deep dives on markets, tech, and investing. Thanks for watching, and I'll see you in the next one.